The YouTube channel is up. I just want to put all the videos before I start giving it out. Okay. Okay. Now, once more, good evening to everybody. And today we'll be looking at candlesticks. You know, I think it's the core. It's not the core of technical analysis, but it is what I would call the most basic. Who is that with background noise? Abubakar, please. I'm going to mute you. Salut, Abubakar. Okay, I'll just mute my people. Yeah, baby. 15 minutes. 5:30. It just the disabled will respect the time. That woman disabled will respect the time. Please, I'm on a Zoom call, please. One minute, please. I have something blocking my screen here. Why are these people forcing me to apply? You should excuse me. I don't have notes, so I always get all my notes online. These people are trying to do me complications. Okay, so today we'll be looking at candlesticks. As I was saying, candlesticks are the most basic tenets of all analysis that you do. Not only candlesticks, but bar charts, line charts, any analysis you want to do as a technical analyst. This is where you start. You start from the basic unit. You have to learn how to understand charts. And this is what I'm going to be using today. I have some basic rules when you're doing candlesticks. I have some basic rules, and I'll be taking you through those rules so that you also try to refine your knowledge. When I saw the list of those who are online now, I was feeling like we should not be doing candlesticks, but I remember the thing that changed my training around, if I was not in that class, if I decided to stay out of that class, I might not have, been the kind of trader I'm getting to today. So I think I respect Mr. Charles for that. No knowledge is too small. Okay. Today we do candlesticks and we do support and resistance. All those are elements of price action. Okay. All those are elements of price action. And me, I'm a price action trader. I don't use indicators. I hope the light behind me is not disturbing anybody. I can switch it off. Okay, so I'm a price action trader. I am a typical price action trader and I use a lot of candlesticks. Okay, I use a lot of candlesticks. So I use a lot of candlesticks and, it's what I want to share with you people today. First thing, candlesticks, the highest confusion that a lot of people have about candlesticks is the fact that they don't understand the fact that every candlestick represents a time period. Okay? Every candlestick represents a time period. That means you can have a candlestick for 1 minute, you can have a candlestick for 15 minutes, you can have a candlestick for 4 hours, you can have a candlestick for a week, and you can have a candlestick for a month. You can even have a candlestick for a whole year. That is the first thing you need to know about candlesticks. It represents a time period. That means a candlestick that for 1 minute is going to be a candlestick that it's going to be a candlestick that is representing from the first second, a candlestick that is representing from the first second right up to the last, right up to the 59th second or to the 60th second. That means it is taking the value of price from the first second to the 60th second, that is a candlestick that represents 1 minute. And the second most important thing about candlesticks, the first, like I said, is the fact that it represents a time period. Every candlestick represents a time period. And the second is that every candlestick contains 4 vital information. Every candlestick contains 4 vital information. And these 4 vital information are the open price, you have the close price, you have the high price, and you have the low price. Okay? Those are the 4 vital information that you have to understand about every candlestick. It represents the open price, the close price, the high price, and the low price. Okay, we have 2 candlesticks here. Whenever I teach candlesticks, I tell people 2 things. The color does not matter. It does not matter whether it's a white candle or it's a green candle or it's a red candle. What you should be able to understand from every candlestick is what the price is saying, what these 4 different information are saying. Okay, what is the high price or what is the open price? The open price is the first price that you have when every time period is beginning. If it is the 1 minute candlestick, it means the open price will be the price at the first second. Did you get that? If it is a 1 minute candlestick, it means the open price will be the price at the first second. The close price is going to be the price at the 60th second. And the high price is going to be the highest price within the first and the 60th second. That means the highest price that the market will attain within that period is what we call the high price, and the lowest price is what the market will attain within that period of 60 minutes. So if we are doing a 4 hours candlestick, it means that the open price is the first second of the first hour, and the close price is the 60th second of the 4th hour. Okay, in a 4 hours candlestick, there are how many minutes? There are 240 minutes. And in a 4 hours candlestick, there are 240 times 60. That should be 240 times 2,400 times 6, which is approximately 14,000, which is 14,600. It means that in a 4 hours candlestick, there is 14,600 seconds. So the open price is the price at the first second, and the close price is the price at the 14,600 second. So that is what you should understand about candlestick. It represents a time frame. A weekly candle represents the open price on the first minute. That means the first minute of trading is on Sunday at 10 p.m. Central African time for me, and the last minute of trading is on Friday at 9:59 p.m. Central African time. That represents a weekly candle. It takes the movement of price within that interval. And when people always ask me, how is a candlestick formed? The response I give them, a candlestick forms because price is always moving. You see? So long as price is moving up and down, you can have a candlestick for 1 minute, 2 minutes, 5 minutes, 10 minutes. All is that you consider the open price, which is the price when the candlestick, when the time starts, and the close price, which is the price when the candlestick closes. Okay, when you explain this like this, I've discovered that a lot of people don't get it. We are going to do a very small exercise, okay? We are going to do a very small exercise for me to really explain to you how candlesticks are being formed. Okay, I'll share another screen now. I'm sharing a Microsoft Word screen. And what we are going to do is that we are going to do a simple assignment. This assignment is what I always use to explain candlesticks to new people. Imagine that your boss, or you sell in a cell phone shop, and they give you a cell phone and they tell you, we want you to sell this cell phone, but we want you to sell this cell phone after 4 hours. Okay, we want you to sell this cell phone. We want you to sell this cell phone after 4 hours. We don't care the highest price. We don't care who gives the best price. What we are interested in knowing is what was the price after 4 hours. Whoever gives you a price after 4 hours, you give the phone to that person. Okay, let's draw the candlestick now for that action. Let's draw the candlestick for that action, please. Let's be attentive. So this is our first second. Okay, our first second, a client comes and tells you that they have 2,000 francs for that cell phone. 2,000 francs for that cell phone. After five seconds, another client comes and say they have 500 francs for that cell phone. After 30 seconds, another client comes up to you and say they have 4,000 francs for that cell phone. And after an hour, 1 hour, a client comes up to you and says they have 5,000 francs for that cell phone. After 1 hour, 15 minutes, after 1 hour, 15 minutes, a client comes up to you and says they have 800 francs for that cell phone. After 1 hour, 30 minutes, another client comes and says they have 10,000 francs for that cell phone. And after 1 hour, 45 minutes, another client comes up to you and says they have 6,000. After 2 hours, another client comes to you and tells you that they have 4,000 for that cell phone. After 2 hours, 30 minutes, a client comes up to you and says they have 9,000 francs for that cell phone. After 3 hours, another client comes up to you and says they have 15,000 francs for that cell phone. After 3 hours, 30 minutes, a client comes up and says they have 200 francs for that cell phone. And after 4 hours, a client comes up to you. A client comes up to you and says they have 7,000 francs for that cell phone. Okay? So now, are you seeing my screen? Oh, let me share the screen. Sorry, I did not share that screen. So that is the screen for our price action. You can see we have a list of prices. Okay? We have a list of prices ranging from 2,000 francs at the first second, 800 francs at the 1 hour 15 minutes mark, 9,000 francs at the 2 hours 30 minutes mark, and 4,000 francs at 7,000 francs at the 4 hour time frame mark. Okay, let's do something now. What we have to do is that we have to list down the crucial prices. How many prices do we have? We have an open price, we have a close price, we have a high price, and we have a low price. Now let's do a candlestick for this price action. What is our open price? Our open price is 2,000 francs. Okay, remember that is the first price. I hope you can see my cursor. That is the first price at the first second. Okay, it was 2,000 francs. Now, what is our close price? Our close price is going to be 7,000 francs. Okay, our close price is 7,000 francs. And what was our lowest price? Our lowest price was 200 francs. I don't know what this person was thinking, offering 200 francs for a cell phone. And he's very lucky. He might have bought the phone if he came at the 4th hour. He might have bought the phone for 200 francs. And finally, our highest price was 10,000 francs or 15,000 francs. Within that period, the highest price we had was 15,000 francs. So you can see there are a lot of prices. There are a lot of prices that were offered within 4 hours, but we needed just 4 crucial prices. We needed just 4 crucial prices: the open, the close, the high, and the low. Let me draw your candlestick for you now, so that you should see your candlestick based on these prices. I hope my Microsoft Word is still as good as I used to know. I want to insert a rectangle. Okay, that is it. Let's draw our candlestick. Our candlestick, that is our real body. Remember, a candlestick is made up of a real body and a wick. That is our real body. And then we have our wick. Our wick will just be a line. And then I want it to be a thick line. Okay. And then what I'm going to do is that I'm just going to copy and paste this line. And I'll paste that line. Okay, so this is our lower wick. Okay. This is our lower wick. Now, that is our candlestick for that price action. Okay. Please ignore the color. The color does not matter. What you should know is the open price, the close price, the low, and the high price. Okay. So first thing we want to do now, we want to identify all those prices. We want to identify all those prices. So what I'm going to do is I'm going to identify all those crucial prices for you to see. So our high price, like we saw, was 15,000 francs. That was our highest price within that price action. Okay. Our lowest price was 200 francs. Our lowest price was 200 francs. Our open price was 2,000 francs. Our open price was 2,000 francs. And our close price was 7,000 francs. My brothers, this is our first candlestick. Okay, this is our first candlestick, not looking at any chart. This is our first candlestick that we have drawn, and I'm going to explain it to you. And what I want you to know is that you should understand the story of every candlestick. Every candlestick has a story, and you should try to understand it. So this candlestick, when the market opened, this candlestick started at 2,000 francs. Okay, it went right up to 15,000 francs. Can you see? It went right up to 15,000 francs, came back down to 200 francs, and then went back up and closed at 7,000 francs. Okay, so this is the price action. So the price range of this candlestick was from 200 to 15,000, but it opened at 2,000, closed at 7,000, but there was also a time when the price went down to 200, and there was also a time when the price went up to 15,000. That is why I always tell all candlestick traders, wait until the candle closes before you make a decision. Don't make a decision on a candle that is still active, because this price can live from here to down here, and then you say, okay, since it's going down, let me sell. You sell, and then it goes back and closes up here. That is already a different story. So this is our first candlestick, and we have seen how it is represented in time. It is represented in time because the boss of this shop said that whatever price somebody brings after 4 hours, you give them the phone. Whatever price they bring, that means in that shop, they don't sell to the highest bidder, they sell according to time. Every 4 hours, they sell anything, no matter the price that was brought. And that is how candlesticks are being made. When you say you want to make a 1 minute candlestick, it means that after every minute, you have to take a new open price, you take a new close price, you take a new high price, and you take a new low price. So this is our first candlestick. And I'll bring you up now to the third thing to know about candlestick. There are two types of candlestick price action: a bullish candlestick and a bearish candlestick. Now, I don't need to see the color of a candlestick. When a candle or when a market opens at a low price and closes at a high price, it forms what we call a bullish candlestick. What we just have here is a bullish candlestick because our market opened at 2,000 and then it went up to close at 7,000. That is a bullish candlestick. A bearish candlestick is when a market opens at a high price and then it closes at a low price. Okay, let me just modify this information a bit for us to do a bullish candlestick. So the first price that came in for this day was 7,000 in this case. And then the second price, the last price that came in, rather than 7,000, it was 4,000. That was the last price. So let's just do another candlestick. Let's just do another candlestick for that price action. Okay, what you see now is that we'll just change the open and the close price. That's all what we are going to do. We're just going to change the open and the close price, and it's going to give us a bearish candle. What do you notice? You notice that the high price and the low price do not change. The high price is still 15,000 and the low price is still 200. But now our open price in this case now, instead of 2,000 francs, is 7,000 francs. You see, instead of 2,000 francs is 7,000 francs. And then our close price now is 4,000 francs. Okay, that is our close price now. So the first candle that we did was a bullish candle, and the second candle that we have just done is a bearish candle. What is the difference between the two? The open and the close price. In a bullish candle, the market opens at a low price and closes at a high price. And in a bearish candle, the market opens at a high price and closes at a low price. So those are two candlesticks. Okay, these are two candlesticks. Let's just write here. This one is a bullish candle. A bullish candle. In a bullish candle, our open is smaller. Our open is smaller than our close in a bullish candle. So let me color this one in red and bold it so that you should see. And then in a bearish candle, our open is bigger than our close. Our open is bigger. As a mathematician, I would have just put the sign here, but I don't want to disturb some people. Is bigger than our close. So this is two price action that gives us two candlesticks. So we have the close price, the open price, the low price, and the high price. When the open price is lower than the close price, we have a bullish candle. And when the open price is greater than the close price, we have a bearish candle. So that is candlesticks for you. I think that is all what you need to understand about candlesticks. What I'm going to do now is I'm going to go now to TradingView, and I'm going to try and do a small activity for you people, and you'll see how each candlestick has a different story to tell. Okay, I stop sharing this screen and then I go to Trading view. Trading view, give me a minute, let me look at trading view. Okay, we have our trading view here, and the chart that I have up. Okay, let me share my trading view screen now. Where is trading view? That is my trading view screen. I have the chart of crude oil. I've been following up this guy for a while now. I really want to eat some oil money. People always say oil money, oil money. Okay, let me clearly, you can see I've done a lot of marks on it. I had an opportunity on the 61.8 Fibonacci here today to open another position. So let me clear the whole chart. Okay, this is a 4 hours time frame. Okay, so it has been made easy on these charting softwares. Automatically on your charting software, you know that any candlestick that is green is a bullish candle, and any candlestick that is red is a bearish candle. Let me test all of your intelligence now. Let me put all of you people to the test, and we're going to see who has understood candlestick and who has not understood candlesticks. Okay, I'm going to change everything to the same color. Everything. I will not use a color that you have ever used before. I'll change everything to a yellow. Okay, this is when we are going to know who is who. What you have to tell me now is, how do you differentiate a bullish candle from a bearish candle? Once you understand and pass this exercise, you never ever have a problem with candlesticks again. Now you already have the picture of this chart in your head. Let me go now to another chart that you don't have picture in your head, so that we'll be able to know who is who. I have a very good chart. I'll take you to Euro GBP, which has been almost in a range. Euro GBP has been almost in a range. Let me take you now to the weekly time frame. Okay, brothers and sisters, this is when you have to display a knowledge of candlesticks. You have to be able to tell me which candle is a bearish candle and which candle is a bullish candle on this chart. You see, it becomes a whole different story now. You need to be able to understand candlesticks to the limit to be able to say which one is a bullish and which one is a bearish candle. I'm going to teach you the secret, okay? It is very simple. The close of one candle is the open of the next candle. Do you understand me? The closing price of one candle is the opening price of the next candle. Okay? So, whenever I ask you if a candle is a bullish or is a bearish candle, what you have to do is that you have to look at either the two candles that come before it or the two candles that come after it to be able to determine whether it's a bullish or it's a bearish candle. Okay, let me make it big so that everybody can see comfortably. I'll come here. Okay, if I go there, everybody will fail because there's a gap there. Let me come here. Is this a bullish or is this a bearish candle? This candle that I'm pointing at, is it a bullish or is it a bearish candle? This candle that I'm pointing, pardon?
Your cursor is not on a candle.
Okay, it's blocking the candle, right? My cursor is not on it, but the line is on it. This candle that you're seeing here, is it a bullish or is it a bearish candle?
I can't see your cursor, sir.
Okay, let me call. Hello?
I can't see your cursor.
Okay, yes, I'm on a Zoom call. Yes, let me call you back. Okay, you see? So, this is the candle I'm talking about. This, can you see my cursor now? Am I sharing?
No. Yeah, I can see your cursor.
Okay, so this candle, if I ask you if it's a bullish or a bearish candle, you'll be thinking a lot, okay? But if it was green or it was red, You just hurry up and tell me, oh no, no, it's a bullish candle. Oh no, no, it's a bearish candle. Now look at this. I hope my cursor is not getting in the way. Let me use a smaller cursor, a dot. I don't want.
Okay.
Yes, let me try to use
because from what I'm seeing, your cursor is also on your distance, on your psychological line.
Let me make the background white so that you people will be able to see easier. Let me just try to do a white background so that it will be easier for you people to really, oh no, that one is worst.
Okay, no problem.
Let me choose another color for the candle. Let me choose another color for the candle so that you'll be able to see well. The white background, you'll be able to see very well with this thick blue. Scales, I don't want these crosshairs. Okay, that is it. That is good. You see now, we have a blue, okay? This is the candle I was showing. This candle. Okay, this candle, is it a bullish or is it a bearish candle? It becomes difficult to understand, but once you take into consideration your open, your close, and your high and your low prices, you be putting it into perspective. Okay, the most important is the open and the close price. Please, I say again, the open price of one candle is the closing price of the previous candle. The open price of one candle is the close price of the previous candle, which means that this candle that you are seeing here, if this is the close price of this candle, I really need to zoom this thing again so that it's very fat for you people to see. Okay, this is where I was. Okay. This is where I was. Let me just send a text message. So please, I want you to note it down. The open price of one candle is equal to the closing price of the previous candle. Okay. So if you take these two candles here, you see that you don't even need to know which one is the close, or you just need to know that there are two prices. Two prices have to be on the same place. Okay, I don't know if any of these candles is a bullish or a bearish candle, but what you know is that there is one price here which can be an open price, and there's also another price here which can be a close price. But since this candle comes before this one, it means that this close price of this candle should be up here, and the open price of this candle should be up here. And if the open price of a candle is up, it means that the close price is automatically down. And if the close price is down, it means that, you see, here now there is a gap. This is a weekly candlestick candle. There are always gaps in weekly candles. It's very difficult to explain it with weekly candles. Let me go to the daily time frame so that you people will not get confused so much. Okay, when you come down now to the daily time frame, you see that this candle here, there are two candles with equal prices. It means this one, it closed here, and this one open here. It means this candle is a bullish candle. This candle we are seeing here is a bullish candle. It means this long candle is a bearish candle, because if its open price is equal to the close price of this one, it means that it opened high and it closed low. Okay, it means it opened high and it closed low. Now look at the trick. Even if there is a gap, like the gap here, you want to come back and look at where the two candles are having an equal price. In Forex, you always have two candles with an equal price. The close price and the open price will always be equal for each time frame. Okay, so automatically this candle here is a green candle, it's a bullish candle. This one is a bearish candle. This one is a bearish candle. This one is a bullish candle. This one is a doji. This one is a bearish candle. This one is a bearish candle. Okay, you see, it's very easy for me because I've already understood a core principle. Open price is equals to close price. If open price is equals to close price, it means that this is open, this is close. If open is equals to close, it means if this is closed, this is open. And if open is up, it means that close is automatically down, which means that this candle is a bearish candle. So once you understand that principle of open and close, you don't need to know the color of a candle. You don't need to know whether it is green or it is red. You just need to look at two candles. The open price of one will be equal to the close price of the other one. Please, that is, I think that is the most challenging thing you need to understand about candlesticks, but technology has made it easy for us, okay? Technology has made it easy for us, so I should not make it difficult for you people. I'll just go back to my candles and I'll change everything back to the way they were before, to my green. I'll change everything back to my green and my red. I'll change my candles back to the green and the red. So now you can easily tell me that, okay, this one is bullish, this one is bearish, because you have the green and the red. You see, it changes everything. It changes everything when you have the red, you have the red, you have the green. You can see that it's bullish and bearish candles. Let me just change my background. I cannot put the white background. I always trade with my black background. Okay. So that is it for me. You see, now everything is very easy. You can easily know bullish. You can easily know bearish. Okay. So what I'm going to do is that I'm going to unmute everybody again. And if there are some people who have some questions, please, let's take the questions. If there's something that is not clear, please, you try to ask so that we can clarify. If you have anything that you have not understood, you try to ask so that we can clarify for everybody. I'm trying to stop sharing my screen, and then I unmute everybody. Welcome, Karin. Okay, now please, if there's anything that was not clear with the explanation of candlestick, please, I'll try to go over it. But I explained 4 key principles. If you want to unmute everybody, please, if you want to talk, if you want to talk, I'm going to unmute you. It's really noisy when we unmute everybody. Okay, this is it. This is it. There are 4 key principles. First principle, a candlestick is the representation of price action within a time period. A time period can be a 1 minute, it can be a 1 hour, it can be 4 hours, it can be a week, it can be a month, it can be a year. What you have to consider is 4 critical information: the open price, the close price, the high price, and the low price. Those are the 4 critical information. Then we have 2 kinds of candlesticks. We have the bearish candle and we have the bullish candle. The bullish candle is a price action where the market opens low and closes high. The market opens low and closes high. That's a bearish candle. For instance, the price can start at 2,000 and close at 8,000 or 7,000 or 15,000. That's a bullish candle. A bearish candle is one in which the market opens high, maybe at 7,000 and closes at 3,000. And finally, the 4th important thing to master about candlesticks is that every close of one candle is equal to the open of another candle in an ideal market situation, especially in markets like Forex, where the price does not gap. But you can see this weekend, prices gapped, okay? But where the price don't gap, it means that the close price of one candle is equal to the open price of the next candle, which means if one candle closes at 7,000, the next candle is automatically going to open at 7,000 because it is a matter of milliseconds. It's a matter of milliseconds. As you reach 60 seconds, the next candle automatically starts. So it starts at the price at which the last candle ended. So those are the 4 things to know about candlesticks. It represents a time frame. has four crucial information: the open, the close, the low, and the high price. We have bullish, bearish candles, and finally we have open of one candle is equal to close of the next candle. I didn't tell you the story of candlesticks because it's not usually necessary. You have to buy a book and they tell you they call it Japanese candlesticks because the Japanese used to use it in the year 1640 or in the year 608 to sell rice. It's all what they used to do is that they used to draw price. They do the open price, they do the close price, they do the high price, and they do the low price. So once you understand candlesticks, you have understood the basis of chart analysis. That is the basis of chart analysis, candlestick chart analysis. Bar charts will be the same thing. The only difference is that bar charts don't have real bodies. Okay? So that is it for candlesticks. If anybody has a question, just type so that I can open your microphone for you to ask a question before we go to support and resistance. Okay, anybody with a question, you can just indicate by putting up your hand. There's a way that you put up your hand. I don't know how they do it. Just indicate by saying that you want to say something and we'll open your microphone. In the absence of that, we're going to look at support and resistance briefly. Okay? So when there's no question, there are only two possibilities. Either everybody has understood very well or nobody has understood at all. I just want to think that is the first one. Everybody has understood very well. Okay? So that is it.
I understood.
Okay.
I understood.
Oh, that's good. Okay. So that's, I think the candlesticks now, each time you look at candlesticks, you should be able to say a small story about them. Let me show you people, for example, what I mean by being able to say a small story. Okay, Karin is asking what causes a gap. A gap is caused when the markets close, okay? For instance, we had a gap this weekend because the markets closed at a certain price. So Donald Trump, who is the tweeting president, he went and tweeted something, okay? That means the market closed at about 50 francs. Then Donald Trump went and tweeted something. What happened now is that a lot of people went in the background. When he tweeted, a lot of people went and made moves in the background. A lot of companies, they put orders to transfer money. And by the time...
About China.
Yes, about China. He tweeted something about increasing the tariffs or doubling the tariffs on China. So when he did that, when the computers were all shut down, human beings now, they'll pick their phone and say, okay, I want you to sell me 1,000 euro. Everybody was buying the dollar now over the weekend because they know that by the time the markets open, the price of the dollar would have gone up. The price of all other currencies might have gone down. So by the time the market opened now, all those orders were filled in. And then there was that jump, you know, like maybe on Saturday, you call your customer and say, I have a fowl that I want to sell to you for 4,000 francs. The customer says, okay, wait, I'll tell you by Monday. You see, the customer says, I'll tell you by Monday whether I'll take it or not. But between Friday and Sunday, you have about 3 customers who come and say, sell me that fowl for 5,000. Another one said, sell me for 7,000. Another one said, sell me for 8,000. By the time the customer is coming on Monday, now what is the new price of that fowl? 8,000 francs. That is already a gap. That is exactly the same scenario that causes a gap in the financial markets. When the markets close at a particular price, you have a lot of people who go in the background and they negotiate deals. So by the time the market is opening on Sunday night, the price has already changed. So the market automatically starts at a higher price. That's what causes a gap in the market. That gap is just that distance between the 4,000 and the 7,000 francs is what causes the gap in the market. Okay, I was going to tell stories about candlesticks. Okay, let's just do a small activity. What I want you to do here is that every candlestick here is a representation of price, and I can have something to say about each candlestick. First one, this one is the green, the small green candle, or what we'll refer to as a doji. okay, this candle, or what we refer to as a doji, you see that the market closed, the market opened at a price, it went right up. Okay, if you look up here, you can see, if you look up here, you can see the prices. When I put my mouse on this candle, you see up here, you can see that the high price was 87574, the low price was 8663, the close price was 87038, and the open price was 87005. So that currency did just 30 points, you see. So this candlestick is what we call a doji. The market opened, it went right up, and it came back to close almost at the same area where it opened. The next one is the very long candle, the one that has a real body. It's a very bullish candle. You see the market opened, it went slightly down. You see that the low and the open price are almost the same. On this candle, the low price is 86951, and the open price is 87038. The difference between the two is just about 40 something pips. Okay, but you can see that it went right up, reached a high price, and then came back to close a little bit away from the high price. So each candle, you can say something. This candle started, it tried as if it was going down, and then it came back and closed up. This one, it opened and went right up, and then came back to close down as a bearish candle. So these lines that you see, they are what we call wicks. Wicks are very important. I use wicks to enter the market. I use candle wicks to enter the market. Each time I see a wick or a rejection in the direction of price, I always feel like I can take a new position. So wicks are very important in the market. So that is it for candlesticks. Let's just look at support and resistance. Briefly, I'll try to be very fast. Okay, if you look on my chart, you're going to see some green lines. Okay, those green lines might not be on your chart. Those green lines might not be on your chart. Those green lines are what I use to represent support and resistance for me. And support and resistance is an area where the price comes to make a decision. The price usually comes around these green lines to do a little bit of hesitation before it passes them. So these green lines for me are psychological support and resistance. Okay. The best way for me to explain support and resistance is by using the analogy of a floor and a ceiling. Using the analogy of a floor and a ceiling. Whenever you're standing on the floor with your legs, you are standing on support. You're standing on something that is holding you or is preventing you from going down. So when you are on the story building, when you're on the first floor, you have the floor above that is stopping you, or you have the floor below your feet that is stopping you from falling to the next level. Okay, and you have the one above your head that is stopping you from going to the next level. So that is a very good analogy for support and resistance. That is a very good analogy for support and resistance. Support is the floor on which you stand. Resistance is the floor above you that is preventing you from bursting up. Okay, so that is technically, or that is all what support and resistance is really about. But now you have to be able to understand the way it works. Okay, let me bring up an image for you so that you can be able to better understand how support and resistance work. Okay, give me 1 minute. So you should have the idea of a ceiling and a floor in your head. The floor is support and the ceiling is resistance. The floor is support and the ceiling is resistance. Okay, I'm trying to bring up an image that will better explain it for you. Support and resistance. I have my favorite image that I like to use. Okay, this is it. I stop sharing this screen, then I share my support and resistance screen so that I can explain it to you people. So that I can explain it. Okay. So this is my favorite image. This is what I like to use to explain support and resistance. You see, you can have here, this might be like the ground floor, this might be like the middle floor, and this might be like the top or the next floor. So whenever price is sitting on this floor, it is what we call support, and whenever price is hitting on this top floor is what we call resistance. But now there is this tendency of resistance to always become support. Resistance is always becoming support. It means when you leave the ground floor and you walk up to the first floor, the place that was your ceiling before, it becomes now your support. It becomes your support because your legs are now standing on it. You can see a very good example here. When this price goes up here, it comes back to settle on this place, and this green, this place now becomes support. But remember, this is the same line that was resistance here. This is the same line that was resistance here that has become support here. So support is always becoming resistance. Support is always becoming resistance when you are going down, and resistance is always becoming support when you are going up. So it's very important because you can use support and resistance to trade. Okay, I have two ways in which I identify support and resistance. Let me go back to my trading view. I have two ways in which I identify support and resistance. Trading view, that is it. The first one is that I realized, okay, I realized that price is always coming to make decisions around what we call psychological price levels. Psychological price levels are very easy to know. 1,000 is a psychological level. Is it easier to buy something for 1,000 or to buy it for 1,100 or to buy it for 975? Okay, it is easier to price something at 1,000, and it is easier for somebody to take his profit at 1,000 rather than taking the profit at 975. You say, oh, let me just leave it to hit 1,000. Okay, and when somebody is in a down, is coming down, and they leave from maybe 1,200 to 1,000, they'll say, hey, this thing can go below 1,000. Let me just take it at 1,000. That's why you always see price coming to make decisions around this green dotted lines. If you can see here, if you can see on my price scale, you see that those green dotted lines are always around where prices end with 0, 0, 0, 0, 0, 0, 0, 0, 0. Those are what I call psychological support and resistance. They are very key to me. I cannot trade without using them. I cannot analyze a chart without using them. Let me show you something. Let me remove my psychological support and resistance levels. Let me remove them completely, and you're going to see that you're feeling like you're lost on the chart. Okay, you can see the chart without them now. You see, once you see the chart without those psychological levels, it looks so empty, it looks so blank, because you don't seem to be able to know where you are. You're just seeing lines going up and down, but you don't seem to be able to really understand where you are on the chart. But if I bring them back, if I bring those my psychological support and resistance levels back, you're going to see that you're beginning now to feel like you're actually somewhere. You can actually get yourself on different levels. You can see that, okay, when I came above this line, I tested it before I went up, and then I went up here, I reached the next line, I came back below the other line. So it gives you a little bit of perspective. Those are psychological support and resistance. But it's not only psychological support and resistance that you can see on your chart. You also have what we call the visual. The visual. If you just look with your eyes, you'll be able to see some levels. It does not necessarily need to be on the green line, but you'll be able to see some levels that price is always coming to. When you look at visual support and resistance using candlesticks, you cannot really appreciate them. What I usually do is that I change my chart to a line chart. And once you change your chart to a line chart, you put it on the weekly time frame. Okay? Once you put it on the weekly time frame, it begins to make sense to you. You see that there are some levels where price is always coming to touch. You see, let me pick out some of those levels. I can pick out this level. This is a level that price has touched several times. I can also pick out this level. I can also pick out this level. I can also pick out this level. You see? So once you pick out the levels, you can now change your chart to a candlestick chart. But what did I realize? What I realized was that the ones that I saw with my eyes were always around the psychological levels. You see that the yellow lines are always around the green lines. Okay? You see that the yellow lines are always around the green lines. The yellow lines are always around the green lines. So I decided to ignore the yellow lines and I just work with the psychological support and resistance levels, because the computer is the one that draws them and it cannot fool me. So those are the two kinds of psychological resistance levels that we have. You have the psychological one, which deals with these whole numbers, with these round numbers, and then you have the visual ones, the ones that you can see with your eyes. Those are the ones that I always use to make my price zones. The visual ones, I always make them a little bit large so that I can cover. I don't always take lines, I take rectangles. My eyes is showing me that price is always touching around this level. You see, if I come up here, I'll make another visual line. You see that price is always touching above this level. So what very critical information are you seeing here? You're seeing that price has gone below this level that I could identify with my eye. If I'm not mistaken, Karin was asking me, how do you identify those zones? It's very easy. You try to draw a rectangle that will cover a few price tips. You can see that this one has covered 1, 2, 3, almost 4 price tips. This one has covered 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So a very important price zone has been broken, and I'm hoping that Euro GBP is going to continue going down. At least Euro GBP, what I'm hoping for Euro GBP is that it's going to, at least it might come down to this level. You see, that is what I'm hoping for Euro GBP. This is the next level where I'm hoping for it to come down. It must not come, but that is technically the next thing, because whenever you have broken a support or resistance level, you are expecting it to come to the next level. So that is it. Okay, I'm going to stop sharing my screen now, and then what I'll do is that we might take a few questions. So if you have a question, if you have something that you have not understood, please also tell yourself that you cannot understand everything today, okay? It's going to take you time to be able to grasp all of these things. But where you want to start is on support and resistance. That's where you want to start with your analysis. With candlesticks and support and resistance. Once you understand those two basic things, it's going to be very easy for you. Okay, so that is it. That is it for candlesticks. I hope I managed to break down the explanation, and then also for support and resistance. I was telling you the theoretical part of trading cannot take you up to a day. No, it cannot take you up to a month to understand if you're driven, if you're dedicated. Now that I've explained candlesticks, you can go on your charts, and all what you can try to do is you try to identify your open, your close, your high, your low price. You try to identify the various time frames, and from there you can start looking at support and resistance. You try to pick out those zones. you try to pick out those visual zones. You try to pick out those zones where the price comes to several times, and you're already on your way to doing technical analysis. Okay. Any questions? Remember, you can just unmute your microphone and you ask a question. If you don't have any question, what you can do is that you can go back now and you try to watch 1 or 2 videos on candlesticks. Meanwhile, I put up this recording. I'm going to put up this recording for candlesticks, and you know, we are good to go. You can go back there and you try to understand the explanation. Okay, I think everybody is unmuted now. I have a question on the chat. Okay, the psychological support and resistance. Somebody is asking if those lines are special lines. They are lines that are drawn by the computer. You just go to TradingView, and if you know how to use TradingView, all what you do is that you tell it to draw a line on all psychological price zones. It's going to draw it for you automatically. I can just remove and put them back with a click. So, you know, we are still on candlesticks. For you to be even be able to use candlesticks, you must be able to use your TradingView. So we are going gradually. We are getting there gradually. Okay. So in the absence of any more questions, I just want to thank all of you who were there. The minute we put our videos on the YouTube channel, you can start sending a few friends to go there. And what we are looking to do is to build a community. We'll be able to help each other analyze their charts, give our own opinions about charts. But I think next Tuesday we are going to do something for the old guys. We are going to revisit risk management. I think that is the key for our old people. You need to understand risk management to the core. You need to be able to respect it the way you respect your Bible. So we'll look at risk management next Tuesday.
Perfect.
Yes.
That's perfect.
Yes, we'll go to risk management again next Tuesday so that people can actually be protecting their capital, protect what they have in their accounts. Okay, that's good.
That's good.
Yes, have a nice evening then.
So,
hello?
there is like
Okay.